Boomer, welcome to the presentation, and thank you so much for attending today. Boomer and I met through Jake and Gino quite a few years ago now, and recently Boomer did a cost segregation study for my latest purchase in Arkansas. It's a process that really was worth doing, and Boomer is from Cost Segregation Services Incorporation, CSSI, and he will share with us now a cost segregation study and a few other bits and pieces which are very important to know about the cost segregation, and it's very similar to the deal that he just done for me. So please, Boomer, take it away, and you can share your screen, and please introduce yourself and everything else.
All right, I appreciate it, Hadar. So what I'm going to do is I'm going to give you guys a brief synopsis of what cost segregation is. I know a lot of you guys on this call have either been through the process before or are familiar through other educational avenues that you guys have taken. But for those of you that are not familiar with it, what cost segregation is when you purchase a property, everything is being depreciated as one single line item on your depreciation schedule over 27 and a half years if it's a multifamily property, or over 39 years if it's a commercial property or an Airbnb. So what an engineered cost segregation study does is it'll break your building down into probably 40 or 50 different components and place those components into their proper and shorter class lives. Your goal as an investor is to shorten down the life of as many assets as possible. So what a cost seg study does is it's going to place a dollar value on each one of those 40 to 50 assets inside your property and then place them into their shorter class life, which we're going to more align them with their actual useful life. Because, for example, we know that carpeting is not going to last 27 and a half years. So as you'll see in the examples below, when we get into an actual property, what we do is we're going to place things into three separate buckets. We're going to place them into a 5-year bucket, into a 15-year bucket, and into a 27-and-a-half-year bucket. Now, when Trump released the Tax Cuts and Jobs Act in 2017, he said any asset with a class life of less than 20 years, you can take 100% bonus depreciation on and reap that all in year one. So it doesn't matter what we put in the 5-year bucket or the 15-year bucket, those are all going to be treated the same. You're going to be able to fully depreciate that in the current tax year.
Boomer.
So, go ahead.
Did you want to share a screen or not yet?
Yeah, I am in a second.
Okay.
Yeah. So as you're going to see in the examples below, we're going to place things into three buckets. For example, the carpeting, the molding, your kitchen cabinets and countertops, your light fixtures, your window coverings, your appliances are all going to go into a 5-year bucket. And things like your parking lot, your landscaping, if you have any fences or walls, things like that are all going to go into a 15-year bucket. So what cost seg does is it allows you to depreciate your property over a faster schedule, which increases your annual depreciation, which reduces your income, which reduces your tax liability, and ultimately increases your cash flow. So the accelerated method is the IRS's preferred method. The study just has to be performed by an engineering firm. So if you don't use one of the big 4 accounting firms, chances are they don't have the engineers in-house, and it has to be outsourced to a firm like CSSI. Okay, so what I'm going to do is I'm going to go through this property here, and 1 second here.
Guys, and while Boomer is setting up the share screen, I want to share with you that I rang Boomer about the deal. We actually started the conversation before I even closed on the deal. And once we closed on the deal, I kind of waited a little bit. So I closed on the deal in November last year, and Boomer got in to do the cost segregation sometime in late January. So we're going to ask a few questions for Boomer at the end about the timing of that, and do you have to do it within the first financial year when you bought it, or can you wait, or a few other questions that I got for Boomer. But what I want to share with you is that Boomer basically had to send someone to my market, and that's how they do it. They can do it across the nation. They fly an engineer in, and they do the cost segregation for you, which was scheduled with my third-party property manager. So please, Boomer, take it away.
Yes, that's correct. So what we do is we will come out to your property. We'll probably take about 150 to 200 pictures. We'll get any kind of blueprints or drawings that you might have. And then our engineers will basically go and reconstruct your building. Okay, so on this property here, we're going to look at, so a good question is going to be does Cossack only work on new properties, or does it work on existing properties as well? So on this property here, the client purchased the building and then went ahead and put in an additional roughly 100 or 150 grand of renovations and improvements. So you're going to see a lot of that in this first page here. So every single individual building has to be studied individually. So if you have an office, if you have a clubhouse, if you have 10 buildings on your property, if you have a garage, if you have a storage facility, each building has to be studied individually. Now, that's not going to matter anything to you. That simply does what we do. So here we're looking at the site, okay? So we placed a dollar value on the site of 137 grand. So we were able to pull forward roughly less than 1% into 5 and 7 year, but we were able to pull forward 75% into 15-year property. Now, like I mentioned before, it doesn't matter which bucket it goes into. If it goes into a bucket of less than 20 years, you're going to be able to fully depreciate that item in year 1. So when you scroll down to this page here, you kind of see what we broke it down to. We broke down the parking lot, this exterior signage, the sidewalks and curbs, the landscaping, the security light poles, the exterior fencing, the fire hydrants, exterior concrete pads, and the basketball court. We were able to all pull that forward into 15-year property. So we were able to create an additional $104,000 of depreciation expense in year 1 by doing this. So a lot of times it's going to be things that you might not even think about, but as you go through the process, you'll be able to see the kind of items that we're able to accelerate and move forward. So this is all on the exterior of the property. This has nothing to do with any buildings. It's all the exterior of the property.
Boomer, excuse me, can you, well, if you got more tables like that, if you don't mind just zooming in one notch so we can see it a little bit better. Oh, that's better. Thank you.
That's better?
Yes.
Okay.
Boomer, before we continue, 1 second, just to get the people who don't know a lot about cost segregation. Hadar, you did the cost segregation of your property. How much did he save you? Over $200,000, correct?
300.
Guys,
you will
explain it real quick, Hadar.
You will see a similar study in a minute, which Boomer is going to touch on it, but pretty much the accelerated depreciation was close to $300,000, which probably going to take me 2 years, if not 3, to use. And then there is another amount, which was from memory about 20 grand, which will be moving forward for another 20 years, which are not going to pay income on. So basically,
and this is why we buy real estate. The main reason.
Okay. Boomer, is this a good time just to ask a couple of questions, Boomer?
Yeah, if people have questions, you can go ahead and ask. I'll tell you what, let me get through this page and then we can go to questions.
Okay, thank you.
Okay, so this was all in the exterior of the property. As we're going down, there's an office. So he had a small office on the property that was worth about 22 grand. So we were able to pull forward 24% of that 22 grand office into 5-year property. So things in the office that we were able to pull forward were able to be like the cabinets, the moldings, the flooring, the wall covering, the window treatments, anything specialty that you have in your property that makes the building more comfortable. Those are things that we're going to be able to accelerate. So you see here that he had a specialty HVAC dryer vent, able to pull that forward. Specialty plumbing, able to pull that forward. Any kind of signs, the lighting, the mailboxes, and then appliances, we were all able to pull into 5-year property. Then the structure of the building, are always the things that are going to stay in your 27.5-year property. So things like your roof, your foundation, your HVAC, all things like that are going to stay in 27.5-year. But on this office, we were able to accelerate an additional $5,000 of depreciation into the current tax year for simply the office on the property, not any units, just the office. So this property had quite a few units. So we're just going to go through one building here. So I think there were probably 10 or 11 buildings on this property, but one building we were able to put a dollar value on, $85,000. We were able to accelerate 23% into 5-year property, and the remaining 77% stayed in 27.5-year. So these items right here, same kind of thing that we were able to all place into a 5-year bucket. So on each individual building of the property, he's going to get an additional $19,000 of depreciation, which you'll see on the next page. But the same kind of thing, all of these things here, we were able to accelerate and move from 27.5 into 5-year property. And one key thing to note is that as the client does renovations and improvements going forward over the life of the property, we've already placed a dollar value on these assets and separated each individual asset to its own individual line item on the depreciation schedule. These assets are no longer intertwined with the original building. They're their own individual asset. So let's say in a couple years that he goes and replaces all of the flooring in this. I know that this building is a few years old, but whenever a ownership changes hands, the depreciation starts over. The IRS looks at this flooring as being brand new. So in 2 years, whenever he has depreciated 2/27 of the flooring, there's still going to be a lot of value on that. And whenever he goes and throws that flooring in the garbage, he can still get almost all of that depreciation expense immediately because it's its own individual line item. It's no longer intertwined with the building. So rather than having everything intertwined with the building over 27.5 years, you're going to have things into a shorter class life, as well as they've already had an exact dollar value placed on these, because what we are is we are calculation experts, and we place dollar values on these that are irredisputable by the IRS. These are exact numbers. So, and then you kind of see down here in the building, same kind of thing. These are all things that stayed in 27.5-year property. But in a couple years, if he has to go replace the roof, or he has to replace an HVAC, or he has to replace the windows, what he throws in the dumpster is going to have a value to him because the building has been componentized and everything is no longer all intertwined together with one single line item. So going back over to what he said in terms of what the savings ended up being. So we're looking here. We got a building cost of roughly $1.1 million.
Boomer, excuse me. Let me stop you here for a minute, because before we jump into this, this is the nice part. This is the part when you can really see the money in your pocket. But before we go into that, guys, I want to share something with you. The reason I choose to use Boomer and a cost segregation company is because if you get your CPA to do it, I believe it's the straight line or the streamline, simple way, without getting it into granular, into really, really itemized through a cost segregation study, you can still be audited by the IRS, and they got a bigger chance to getting you. When you use the cost segregation engineer to do that, they will also protect you, and it's much more resilient in terms of an audit. Is that the right assumption, Boomer?
Yeah, that's correct. So our company, Cost Segregation Services, has been around since 2001. We've performed over 22,000 studies in all 50 states, and we've never had a single line item overturned. So these are completely bulletproof to you. In the event that you're audited for some reason, we defend our work 100%. The IRS will call us. We'll get on the phone with them, explain our calculations, explain our process, how things were done, and then you'll be home free. So we've never had a single line item overturned, so you have nothing to worry about. Our name's on everything. We take all liability, and we defend you at no additional cost.
Here's another thing. Guys, I have an amazing accountant, Todd Newman. He handles about 17, 20 of my LLCs. Most times your accountant, he's, your friends with him, he's a good accountant. This is a lot of work. Most accountants don't want to do this. And a lot of accountants, believe it or not, you think they do, they don't know how to do this. So they'll do it for you. They might not even do it correctly because they're so overwhelmed. They don't really want to do it. So this is his job. He takes this even more seriously than them. And you think your accountant cares about you a lot of times? Not really. I have a couple friends right now, their accountant's not doing the right thing by them. So that's why, like Hadar said, you would use somebody like Boomer who is going to give you a perfect report.
And Boomer also communicates with your accountant if required, and really stay in touch on the yearly updates once you, for example, in our project, Boomer, which is another point I wanted just to touch on before we get into that, is that you asked me, Boomer, to provide you all the invoices, if you like, and all the costs that I spent so far before you've done the actual cost segregation study. So basically, I bought the property. I already spent about 150 or close to 200,000, 180,000 before Boomer did the cost segregation. So Boomer asked to see all those expenses so he could factor them in, and all the invoices so you could factor them into the calculation.
Yes, that's correct. So what we do is we don't simply want to be a cost seg vendor to you. We give you the full report, and in a few weeks when it's done, we shake hands and go our separate ways. We more want to be a partner within your tax team to help you throughout the life of the property. And we're not like an attorney. I'm not going to start the clock and bill you whenever you pick up the phone and call me or email me or anything like that. Everything is included in your cost seg study. So what we do is this is all that we do. We are experts in this. So your CPA probably does a very good job for you to file your taxes, keep you in compliance, keep you out of audit, but it is not their job to find tax savings opportunities for you. And that's why I commend all you guys for seeking out additional education, being a part of Jake and Gino, being a part of self-improvement, making yourself more aware of what's going on, because the tax laws are designed for everybody. Every single Fortune 5000 company has used cost segregation, but the same laws that apply to Apple and Google and United Airlines apply to you and I as well. So we simply want to make you aware of the opportunities available to you. And if it makes sense going forward, great. If it doesn't, at least you know that you've exhausted every opportunity available to you. So Donald Trump is the face of cost segregation, and the laws are very, very building owner friendly right now. So now is the time to take advantage of it. And one thing to point out is that we can still do things for 2019. So if you're on extension or if you've already filed, we can go ahead and help you save money on a property that you purchased in 2019 or any years prior, and you can get immediate cash flow that you can use right now. So kind of keep that in mind. And if you have any questions, simply reach out to me, reach out to Hadar, Marco, anything like that, and then we can kind of piece it together and we'll look at your property individually here. Okay. So going back to the property on the screen here, what we have is we have a building cost of roughly $1.1 million. What that is that's going to be your purchase price, excluding land, plus the amount of renovations and improvements that were done. So you cannot depreciate land, but you have your purchase price plus any renovations and improvements that you do going forward. So what we're going to do here is we're going to look at this spreadsheet here. So are the numbers big enough for you to see?
Yeah, zoom in a bit. Zoom in a bit, yeah, please. A little bit more? Yeah, that's good. Yeah.
That's good? Okay. So right here, we have the building cost of $1.1 million. Over here in the top left-hand corner, there's the box that says 5-year property, 7-year property, 15-year property, and 27.5-year property. So on the sheets that we looked at before, we were able to accelerate roughly 20% of the property into 5-year, roughly 9% into 15-year, and then the remaining 70% stayed in 27.5-year. So we are not taking all of your depreciation for the life of the property. We're simply taking what the IRS allows, which is roughly 30% here. So the columns that are going to matter most to you over here is going to be the fourth column from the right, which says timing difference. So we were able to create an additional $324,000 of depreciation in tax year 2019. The beauty of cost seg is it is not a use it or lose it. Whatever you don't use in 2019, you can carry forward to subsequent years indefinitely. So you're going to have an additional depreciation expense of $324,000 in 2019, and there is one cost seg done per property. However your partnership structure is split up, that's what percentage of the $324,000 you get. So it doesn't matter if there are 2 partners or there are 30 partners. There's simply going to be one study. We will work with your CPA if they have never been through this process before. All they're going to do is they're going to take their straight line number plus our accelerated number, and that's going to give them the happy number that they submit to the IRS. So like you'll see here, if you look at this column here, total depreciation with analysis, he's going to have $336,000 of depreciation in tax year 2019. If he did not do the cost seg study, he was only going to have $11,000. That's because he bought the building in September of 2019, so it's prorated for that portion of the year. So instead of $11,000, he's going to have $336,000 of depreciation to use in 2019. And then kind of like what we mentioned before, cost seg is all about the time value of money. It wants to keep money in your pocket, you the smart businessman, you the smart investor, to use it however you want to use it for. If you want to buy another property, if you want to fix up a property, if you want to pay down debt, it's keeping money in your pocket. And then going forward, he's still going to have $28,000 of depreciation each year. He would have had 40 if he didn't do cost seg. Now he's got 28, but he has an additional 324 grand in tax year 2019, and he probably won't use it all, so he can carry it forward to subsequent years.
Guys, $28,260 moving forward for 20-something years that you're not going to pay tax on. Free. Pretty much. That's
so, and then as he does renovations and improvements going forward, we'll continue to work with him to be able to expense probably 80 to 90% of what he did. That is not going to have to be capitalized because his building has already been componentized and everything's no longer intertwined. So yes, he reaps a nice $324,000 savings in 2019, but he's going to save a lot of money going forward over the life of the property because the building has been componentized.
Boomer, what's going to happen now moving forward when I keep spending money on my repositioning? I'm still going to spend, let's say, another 150 or 200 on those apartments. Now, you asked me by the end of the year, of this year, 2020, to give you the expenses that we spent within the year. What are you going to do with that?
Yeah, so what we're going to do is that we already have pictures at your property because we've already been there. We've already placed exact calculations on the components in your property. And what we're going to do with your invoices going forward is we're simply going to do what is called a partial asset disposition. We're going to take the amount that you spent in 2020 or 2021, and we're going to be able to create a new calculation to be able to save you more money on the renovations and improvements that you did in that year. So ideally, we want to help you expense as much of that 100 or 150 grand as possible, but whatever you don't use, we will cost seg the new stuff as well.
Thank you. You got anything else apart from that to add on here, Boomer?
No, I mean, this is a very easy process. Simply reach out to me. You can text me, call me, email me. And what we'll do is we'll take it and look at your individual property and your individual situation. Our engineers will put together an analysis for you, which will look very similar to this. And we'll just have your calculations up here that's going to apply to yours. But I simply need 4 questions answered. when was the building purchased? What was the purchase price? Are you doing any renovations and improvements? And what's the address? Or if the building's already been in service, your accountant's going to have your depreciation schedule, and that'll give us all the information that we need. So we will put together a no-cost analysis for you. There's nothing out that you're out the front end, but it makes sense. If you've owned a property in 2019 or going forward, this is something that you need to look at because you can get immediate cash flow now in your pocket to use going forward. And then as you guys are starting to get into new properties, as you get new deals, simply reach out to me as soon as you get an LOI, and then we'll be able to put together an analysis for you that you can show to your investors, and they're going to be like, wow, I'm going to have this much additional savings in the year that we buy the property. It's a way to be very attractive to investors as well.
Well, here's a simple example for a smart businessman. You could let your accountant do it and him lie to you and he says he's going to do a good job and maybe get back, say, $20,000, I make up fake numbers. Or you pay a little something in business world and you can get back $40,000 doing a cost seg, doing it right. So, you know what I'm saying? It makes sense. You know what I'm saying? Do you want it done right? And do you want to maximize and protect yourself, like you said, against the IRS? So to me, yeah.
Boomer, what's the minimum value of property that you will recommend somebody to do a cost seg? I mean, would you recommend it on a property worth $700,000, or does it need to be over $1 million? What do you recommend?
No, that's a very good question. So with the advancements in technology and a lot of sweat equity from us doing this for quite a few years, the costs have come down considerably. Right now, if you have a property that has a cost basis, remember cost basis is purchase price plus renovations and improvements. If you have a cost basis of $250,000 or more, we can normally create a pretty compelling ROI for you. So even on smaller properties, if you have a single family home, if you have a duplex, a fourplex, anything like that, those can still work. So we're simply working off of hard numbers here. And what Marco was talking about before is a lot of times after a year, you guys will do a refinance or anything like that. That does not affect this at all. We're simply going off of hard facts, which the IRS cares about, and that's it. So you guys can choose to move your money around and do things like that. That does not affect the study at all.
Thank you. I got a couple of questions I want to still ask you, Boomer. So I'm just going to ask this because it's written down from a member. Can you do a cost seg even 2 or 3 years out after you purchase it?
Yes. Yeah, we can do cost segs going all the way back to 2001.
Wow.
On a building that far back, it's probably going to be fully depreciated by quite a bit. But I would say if you have a building that you purchased from 2010 to the present time, chances are it's probably still going to make sense. Yes. So all that happens then is that we will file a 3115 for you. A 3115 is a change in accounting form. It tells the IRS, I was doing straight line depreciation, but now I'm going to do accelerated depreciation. So your CPA will just submit that form, which we complete with your tax return, and that tells the IRS that you are now doing accelerated going forward. And in that situation, all the money that you left on the table, we will go back and pull that forward and get you caught up to the point that it looks like you did the cost seg study back when you bought the building. So all the money that you left on the table, we will get you caught up to present day.
Thank you. Another question is, what the timeline for bonus depreciation? I mean, we were able to speed up the bonus depreciation and take things down to 5 years and then basically depreciate them in the first year and able to carry them forward. But I believe that about 23 or something, that bonus depreciation will be eliminated or scaled down. What's the story there?
Yes, so going forward, the current tax laws are in effect in full 100% bonus depreciation through 2022. In 2023, it goes to 80% and then 60% going forward. We'll see what happens with the election coming up. These things might be extended longer, but in the current tax laws, yes, it's still 100% bonus depreciation through 2022. And it doesn't matter if we have a change in the White House and the tax laws change. If you do the cost seg study before 2022, you're going to be grandfathered in and you're still going to reap all of the benefits.
Okay. Let's see what other questions we got.
Adar, we got to, maybe even the questions that don't get answered, we're going to give them to Boomer and we'll have him answer them. We'll email him because we got to, I don't want to run too long. I want to move on to Will.
Okay. That's perfect. So feel free to reach out to me. My email is just my first and last name, boomerphilbrick@gmail.com. Or you can simply call me or text me.
Put it up on the chat while Will talks. If you can, put it up on the chat. If you hit the chat button, put it up. And then guys, really email him the questions because I want Will's got a great presentation and he will answer your questions and he's going to network with you. So really reach out to him. Okay.
Yeah, Boomer is great. Thank you, Boomer. I really appreciate your time.
Great. Thank you.
It's awesome to have you around, man.
All right. You got it. I'll talk to you guys soon.
Thank you.